your dad is basically going to give you the house, but he doesn't want to give you the mortgage. You're going to have to, he's not going to pay the mortgage off. You're going to have to take over the mortgage, right? So in theory, I get what you're saying, right? Just have dad add you to the deed, right? And then you would refinance the mortgage into your name only. You're almost there. You, in theory, this makes sense. And the way you need to structure it's different, but it accomplishes the same thing. So what needs to happen, because you don't currently own the property and you're not currently on the mortgage, so it's not that simple. You're going to have to qualify for your own mortgage, but you can do that by purchasing it from dad, and he gifting you the equity. So I'm going to use very round numbers. This happens all the time, especially as our parents get a bit older in life and they're wanting to pass the property to us in creative ways, or who knows, maybe dad's going to move to a condo on the beach and he doesn't want to maintain the home anymore, but he wants it to end up with you. And you may or may not be in the position to purchase something outright. So anyway, I'm not going to go into why this may be happening, but it's an opportunity that we see presented to children all the time. So to answer your question, it's not as simple as just adding you to the deed and then you refinancing the mortgage, because the mortgage isn't yours. So dad can sell you the house and gift you the equity. So I'm going to use round numbers because that's the easiest way to tell a story. Let's say dad owes $80,000 on the property, or let's say he owes $120,000 on the property, and the property is worth $200,000. Well, dad can sell that property to you for any amount over the loan amount up to the value of the property. So let's just, again, use round numbers and say he's going to sell it to you for $200,000, but he's going to give you a gift of equity of $80,000, which means you would get a purchase mortgage for the $120,000. So mathematically, it's really kind of lining up the same way that you described. You'd be refinancing that $120,000 loan that he currently has. But in this case, you'd be purchasing it from him with a $120,000 loan. And instead of bringing money to the table for down payment, closing costs, or prepaids, remember the three buckets that make up cash to close, all of that can be covered in his gift of equity. And assuming that he's lived in the property for more than the required time to forego capital gains tax, he won't have to pay capital gains on the gift, and you wouldn't have to pay gains on the gift. Actually, you know what? Double check that you wouldn't have to pay gains on the gift. I'll double check that. But I haven't seen someone have to pay gains on the gift. But nonetheless, accomplishing your goals, but structuring it slightly different, gift of equity, dad can definitely do that. And assuming that there's enough equity in there, dad could even walk away with a little bit of cash if he needed to. But I'd love to dig in deeper with you on this, because as I mentioned, we see this often, and we're in transactions like this all the time. So if you wanted to discuss it a little further, I encourage you to give us a call at 561-291-8569, or visit the website, www.mr.mortgage. Hit the contact us button. So yeah, it sounds like a great opportunity. It sounds like, dad's setting you up, and what a wonderful opportunity to buy a piece of property in this environment with housing values skyrocketing and interest rates still relatively low. So yay, dad. Way to go, Brandon. But yeah, give me a call. I'll walk you through the details. I can even refer you to a title attorney who could structure the contract for you if you weren't working with anybody who could. So yeah, greatly appreciate that question. And gift of equity might be the easy way to do it. And again, we do it all the time. So hopefully that helps. I wanted to throw a couple things out from the first segment that I didn't get to, because I went off on the budget versus rate thing, because I think it's important, right? And I'm going to try to adopt that and not geek out to the granular level on interest rates. But speaking of buying properties and selling properties, I just pulled a HomeLight study before I jumped on the air today, and they did the HomeLight study for 2022 buyer and seller insights for the last year. And this is interesting to me because we all know how fast things are selling in this market. And a lot of sellers are apprehensive that they don't want to sell until they know where they're going. And we even talked about that. I shared with you one of Juan's pro tips with the reverse contingency strategy. And if you have questions regarding that reverse contingency, I'm happy to get you in touch with Juan or give you more details on that too. But anyway, 10% of sellers who sold their house last year had no idea where they were going to live next, which is mind-blowing to me. I get it, right? They're going to capitalize on all that equity, but most people are afraid to do that. So I guess it's relatively a small number, 10%, but mathematically, that's a lot of people in an Airbnb or at the Hilton on the beach trying to figure out their next move. 50% of sellers in the past year sold their home after living there only 5 years or less, which is against the historical norms. Again, capitalizing on a bunch of equity and making that move. So I just found that interesting. I don't know if Brandon's dad has lived there for more than 5 years, but I found that super interesting that many people were cashing out that early. But yeah, so there goes the siren sneaking up behind me. We are going to move into this break. On the other side of this break, I promise we'll get to more questions, but I encourage you to give us a call at 561-291-8569. That's 291-8569, or visit the website, www.mr.mortgage. Thanks. Hey, it's Mark Eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com. www.reallyGreatAgents.com.
Here's another 5-star review.
We started our loan with a different company. They said we were approved, but at the last minute they told us there was a problem. I still don't know what went wrong, but thankfully our real estate agent told us about Mark. I was pretty stressed, but it's the perfect house, so we gave Mark a shot. He got it done. I'm not sure what was different, but I don't really care. We even got a better interest rate and with less money out of pocket than the first guy quoted us. It was a great surprise. Yes, I'm happy to recommend Mark and his Mr. Mortgage team.
It's not every day that you need an appraisal, whether it's for a divorce settlement, estate planning, or maybe you're appealing a tax assessment, or you just want to make sure you have adequate coverage in your property insurance. When you need a certified appraisal, turn to my friends at SOFLappraisal.com. That's SOFLappraisal.com. Peter and his team have been appraising properties here in South Florida for decades. SOFLappraisal.com. And tell them you heard this on the Mr. Mortgage Show.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right, I am back. Mark Eitel here, host of the Mr. Mortgage Show. And yeah, thank you for being with us. Again, the Anytime Hotline, 561-291-8569. That's 561-291-8569. Dom is here to take your questions via phone or text, and we're also watching the email via www.mr.mortgage. So we're going to dig into some more questions. I did want to throw out the rest of those stats because I misread that and I caught myself off guard. But 27% of buyers felt anxiety when struggling with multiple offer situations. I find that surprisingly low because I hear a lot of people feeling that pressure. But that was a surprising number, only 27%. And 80% of people who bought a property compromised on one of the key things they were looking for in a house. So they might have chosen a different neighborhood, or maybe they chose to forego the pool and just jump in, which I think is smart. I think we need to capitalize on the opportunity that's in front of us, especially the way things are appreciating. The sooner you get in, the sooner you benefit from ownership. Actually, I heard something super interesting this week. I start my day every morning at 7 a.m. with a mastermind, if you will. and it's a call-in group of the very top real estate agents from all over the U.S. and Canada. There's some international agents, but that's the most part of it. And I might have shared this before, but it's a super interesting group of people to get a data set from. And they're all sharing very similar experiences that we're going through. But the thing that I found so very interesting was one gentleman shared something that his father had told him long ago. People don't make money by waiting to buy real estate. They buy real estate and wait. And I found that pretty insightful because if you look at the historical charts, with the exception of the housing crash, there's no significant downturn in home values. And even as ugly as that crash was and as long as it lasted, anyone who bought at the peak of the crash is in the money now. So they had to have a place to live this entire time. So it made sense. But yeah, I thought that was super interesting. People make money not by waiting to buy, but by buying and waiting. So buy and hold that real estate. And you got to have a place to live anyway, so it might as well be yours. Anyway, we're going to dive into some more questions. Let's see if Dom has another one teed up for us. What do we have?
I do. We have Julio sent in a text. Is there a cap or a maximum amount of cash I could take out with the rec loan? I want to pay off everything before rates get crazy.
Hey, Julio, that's a great question. And I commend you for capitalizing on this. I guess that kind of goes back to budget versus rate, right? Because with that rec loan, rec is reduce, eliminate, and consolidate. So we're looking at your overall monthly expenses with a rec loan. So we're taking into consideration your credit card payments, your boat, your motorcycle, your car, whatever you have. And we're looking at the best use of your equity position. Does it make sense to cash some of that out at these low 4% interest rates and pay off those higher interest rate credit cards and other consumer debt? So there is typically an LTV. An LTV means loan to value. So typically the rule of thumb when you're pulling cash out is you want to keep it at 80% or less of the value of the property. So if your property is worth, $500,000 and you were going to pull 80% of that out, you could go to the $400,000 loan amount, and then whatever your payoff for your current first mortgage is would be reduced would be reduced from that. And I'm hung up on the R in the rec loan, but anyway. Typically 80% is the rule of thumb for pulling cash out. And I don't know how much cash you have in the house or how much debt you have, but it certainly makes sense to look at the rec loan almost as an inflation buster, right? So there's nothing that you as an individual can do about inflation. We're all suffering from it. We're all paying more for everything every day. If you can pull some of this newfound equity wealth out of your property to offset those additional expenses, the Fed moved the interest rate. That means, your credit card payments are going to go up just by the fact the interest rates are increasing. And as that continues, it's going to get worse. So yeah, 80% typically the rule of thumb for pulling cash out. I'm proud of you for thinking about that, and look at all the debt that you can pay off and how that improves your monthly financial outflow. And then if you wanted to, we have people all the time who are saving significant amounts of money monthly, sometimes over $1,000. I mean, all of those expenses that you have for the toys and the cars add up in a hurry. So if you can reduce your monthly expenses by, I'm thinking of one particular young family right now, they paid off everything, and they saved, I think it was about $600 a month, and that wasn't a great big loan, but $600 a month significantly improved their cash flow and took a lot of pressure off dad's neck, if you will, when he's out there trying to make the bills. So I'd love to talk to you more about it. I'd love to see what amount that you're thinking of paying off, and maybe kind of chop it up with you as far as which cards and which consumer debt carry the higher interest rate and where that money might best be used if there's not enough to pay it all off. But yeah, I encourage you to give us a call at 561-291-8569, and we can dig a little bit a little deeper on that. So hopefully that helps. Use the 80% rule of thumb. There's some instances where you can go beyond that, but you're getting into a mortgage insurance requirement, and it's